Hey everybody, welcome to the Halftime Update 2025. I cannot believe it is July already. My clients told me from the very beginning of my career that the more time passes, the faster time goes. In other words, it never stops accelerating. That's what they tell me. I hope they're wrong, but I have a feeling they're not because I've heard it my entire career and I've been doing this for 24 years now. So it's past July. The statistic we were talking about today at our office is that while this past week was the halfway point between being closer to the year 2050 than we were to the year 2000, so there's that. Before we get started, really quick, if you have questions about your portfolio, your retirement plan, financial plan, if you'd like a second opinion on your financial plan, retirement planner, or investment portfolio, there is no obligation. It's just a discussion. That QR code right there in the middle is one way to get a hold of us. You can get a hold of me on social media, on any of the socials you see there. You can email us at info@libertaswealth.com. But the QR code, if you scan that with your phone, it'll take you straight to a questionnaire that'll help determine whether or not you're a good fit to set up an intro call, and that'll come directly to us. So if you have interest in that, fire away, and we'll talk sometime soon. But before we get into the meat of the conversation, I'm going to start with the same quote that I put up here back at the end of the first quarter by Larry Williams, and it goes, "Be quick to turn bullish, but take your time turning bearish. The market is up more than 70% of the time." And the reason I used this quote back at the end of the first quarter when I did the quarterly scouting report is because I had a feeling after, like I said earlier, 24 years of doing this for a living, I had a feeling that we were going to see a V bottom because of the fact that news-driven events, like the one we just went through with the tariff crash, events like that, market crashes, bear markets that have to do with news headlines have a tendency to rebound quickly. And so the reason I'm sharing this quote once again is because, again, that's what this ended up being. It ended up being something that freaked people out a lot. Not that it wasn't justified. I'm not saying that. I'm not trying to minimize anybody's emotions or how they felt about what was going on in call it late winter, early spring. But at the end of the day, emotional, news-driven events tend to create market drops that are pretty quick. In other words, short-lived, I guess, for lack of a better word. When we look at the stock market, I've got a little Mike Sorrentino, the situation. So I'm dating myself here. The comeback is greater than the setback. What we have right here is the S&P 500 and the top pane. We have the blue line is the 50-day moving average. In other words, it's the trend of the S&P 500 over 50 days. And then we have the 200-day moving average in shaded, or the area, and that is what I would call underwater or above water. Obviously, we fell below water here at the end of February. We tried to get back above water here. When I say we, the market tried to get back above water in March. It failed, and it headed lower. We got back above water on a big gap up here, as you can see where my mouse is. And then it pulled back to the 200-day moving average and has headed higher. And we have broken out. When I say we, again, the market has broken out to all-time highs. In the lower pane, this is momentum. Relative strength index is a momentum indicator. And whenever the momentum indicator, in this case, falls below 30, that is bearish. That is not good. In other words, it's been called, we're in a bearish regime when you fall below 30. We have since crossed back above 70, which means we are back in a bullish regime. So it's another piece of positive evidence for the market. So earlier when I was talking about a V bottom, I'm drawing it with my mouse right now. This is a V bottom. Oftentimes when markets bottom and they're not headline related or not news driven, you tend to get this W bottom where the market goes down, comes up, retests, oftentimes undercuts the prior low before heading higher. In this case, we have a V bottom, which again likely has to do with the fact that it was a very news-driven event that took place with the tariff crashes. When we look at bonds, not a whole lot's changed. I don't mean to laugh, but Jerome Powell raised rates faster than any Fed chairman in history, and he's not in any hurry to cut rates. Not likely. He's already said at this point on news that it's due to the tariffs. So at this point, when you go back to the COVID highs, we went limit up on U.S. Treasuries, 20-year Treasury bonds. Treasury bonds are still down more than 50%. I believe it's close to 52%. And when you look at the low going back to this past October, it's only up 5% off the lows. So bonds are still really, really interesting. It's we do own bonds in our clients' portfolios, in our model portfolios for the first time this year since 2022. We were really, really standoffish with the exception of a couple weeks. And I believe that couple-week period was in early summer of 24. Didn't last very long. But this is the reason why. Rates go up, bonds go down. Rates come down, bonds go up. But even then, there's lots of different kinds of bonds. So when I say we're invested in bonds, we're not invested in 20-year Treasuries. I can tell you that right now. We're invested in other bond sectors that obviously are exhibiting, I shouldn't say obviously, but they're exhibiting better relative strength and are showing uptrends. And so that's the bad news on bonds. The good news on bonds or on rates is that as much as we're not huge annuity proponents at our office, being fiduciary, registered investment advisory firm, we are true fiduciaries at our office. The good news about rates being high is that we're still seeing really, really great rates on guaranteed money in tax-deferred annuities, whether it be triggered performance benefits, S&P 500 caps. We're just seeing good numbers still, and that's only going to last so long. And what I mean by that is eventually when the Fed does start lowering rates or cutting rates, it's not guaranteed, but the chances are pretty high that we're going to start seeing these rates go down as well. So for at least the time being, the bad news is bonds have been struggling immensely as rates have gone up. The good news is because rates haven't been cut, there are, for the first time literally in my career, I've been doing this, like I said, 24 years now, and it wasn't until 2023 that these types of annuities started looking attractive for the first time in a very long time. Like I said, my entire career, to be honest. So there's that. If we just pivot and start talking about evidence, things start getting really interesting. There's a death cross, which is when the 50-day moving average on the S&P, this blue line right here, crosses below the blue area, or the black line with the blue area. That's called a death cross. A golden cross is when the 50-day crosses back above the 200-day moving average. That's what we're seeing right here. So the golden cross we've just seen, if you look at the day in history going back to 2000, so which includes obviously the dot-com bubble crash, the Great Recession. There have been 11 times this has happened. The average return 63 days later, in other words, 3 months later, is 5.9% with a 91% win rate. So very high win rate. We're talking one loss, period, and then the average rate of return of 5.9% after a golden cross. So to the people out there that are saying, oh, well, things are getting so good, it's long on the tooth, it's probably time for a pullback. Try not to have an opinion because the market doesn't care what any of us think. The market's going to do what the market's going to do. So just look at the statistics, look at the charts. Are we in an uptrend? If so, get in that trend. Don't be biased. Don't be stubborn. Again, try not to have an opinion because the market doesn't care what any of us think. If that's not enough evidence for you, you've seen the news. I'm sure it's hard to avoid. I don't watch a lot of political news. When I say I don't watch a lot of political news, I watch very little political news. I mean, if I see political news, it's because I'm at my parents' house and my dad's watching it. Literally, that's the political news I see. That's it. But it's no secret to anybody what's been going on in Israel and the Middle East. And if I go back here to 2023 October, war breaks out in Israel. We've got a temporary ceasefire, so the market goes down in Israel. The Israeli stock market comes back. There's a temporary ceasefire. Then the conflict resumes. The market goes up. Go figure, right? The conflict reignites in January of this year. There's a ceasefire. Market still goes up. Things start to come back down. Operation Might and Sword come back. I say sword. Might and Sword, easy for me to say. There's a market pullback at that time. This is the Israeli stock market, so tradable stocks in the Israeli Stock Exchange. ETF is EIS, as in Sam. And now we're at all-time highs. So I don't know what else to show anybody that would indicate that this market is not that poor than to show them the Israeli stock market at an all-time high. But let's move on. This is the US dollar. So, yeah, Israeli stock market is doing well. It's an international stock. Somebody might say, well, yeah, but that's because the US dollar is struggling. When the US dollar goes down, here in the US, obviously, the price of stocks overseas go up. So that's why it's going up. Well, it's part of the reason. It's definitely not the biggest reason. That's for sure. And honestly, the reason doesn't matter. All that matters is, in my opinion, that we're in an uptrend and a downtrend. We want to own stocks, bonds, commodities, currencies, even cryptocurrencies. We want to own investments that are in an uptrend, and we want to avoid investments that are in a downtrend. We want to own investments that are exhibiting relative strength that is greater than the market and their peers over time, understanding that perfection is impossible, but we want to stay invested in the strongest stuff over time. And at our office, in our trend following models, when those trends start to break down, we want to raise cash and wait to trade another day. When I look at the US dollar, though, it did break down below a pretty important level of support, and now we're kind of, leaning on this level of potential support going all the way back to 2021, 22, and the question right now is that going to hold? And when I say is that going to hold, that's going to say a lot about whether or not this market trend is going to continue with international stocks turning into a long-term leader as opposed to just a short-term and intermediate-term leader. And if this does break down, there's a higher probability that we are going to start to see overseas stocks outperform domestic stocks for a longer period of time. Until then, we've seen 15 years of U.S. stocks being the leader with little blips of outperformance by international stocks, and that's it. And that's how we need to treat it. All right. ESPN Fear Greed Index is on the brink of greed and extreme greed. What's that mean? You can see where it was over time here on the right, but we could be due for a pullback. The market could pull back. When I say pullback, I mean 2, 3, 4, 5%. It wouldn't surprise me a bit. So whenever the market's at extreme fear, we expect it to go up. Whenever it's extreme greed, we expect it to go down in the short term. But when you look at the fear and greed index, it's not a long-term indicator. It's a sentiment indicator, and the extremes are what matter the most. But it's not a long-term indicator. It's a short-term indicator. Now, I thought this one was really interesting. This is my friend Ryan Dietrich. He put this together, and what we've got here are major geopolitical events going back in time to 1940, and I found it interesting here. The Hungarian uprising. My dad is from Hungary. He came over. He came over in 1956. The whole Koós Square massacre, and you can see here 1 month after that, the market was down 2.1. 3 months later, 2.8. 6 months later, the market's down 1.3, and 12 months later, 1 year later, the market's down 11.7%. But my point of showing you this is that going back to 1940, there have been 40 times where we've had major geopolitical historical events, and the number of times when the S&P was up 3 months later and then down a total of 12 months later was one time, and it's right down here at the bottom. So take with that what you will, but it's happened one time, and it was an Iranian general killed in an airstrike. I guess my point is the news is counterintuitive, the market's counterintuitive. It's why I don't use fundamentals all that much when analyzing the markets. It's why I definitely don't look at political news when analyzing the markets. I like to follow trends and relative strength because that's what works. At least it works for me. So when we look at the S&P 500's total annual returns going back to 1990, you can see here all the different times that the market started at zero, where it ended up, and right now the market was back in April 8th of 2025. That's this year. April 8th, the market was down 15%. Now it's up 5.6%. And think about how things felt back in April or even March or February. And how people felt, what the news was saying, the world was ending. We were looking at statistics that looked worse than COVID in terms of how people felt about the market. And again, if I go back to the quarterly scouting report that I did back in April, and you can go to our YouTube page and you can check that out. I was saying then, and I'm still saying now, that all these news-driven events have a tendency to be V-bottoms, and that's what we're seeing so far. And here is the post-election year, which is the year we're living in. This is where the market's been this year and where we're at. Here are the averages. The market tends to peak right around August and then kind of pull back a little bit, chop sideways, and then end strong through the rest of the year. So that doesn't mean that's what's guaranteed to happen this year. It just means that since 1949, or in other words, World War II, that these have been the trends. And even though this year has been a whole lot more volatile than most years, I think that this is something we need to pay attention to. And another thing we need to pay attention to is the whole adage that sell in May and go away. Well, so far sell in May and go away. Sell in May and go away this year has not worked. And I think that when certain averages that are supposed to work don't work, I think we need to be paying attention to that as well. Another thing I found interesting is that the recession probabilities have dropped to 21% at this point. Again, remember where we were in March and April of this year, how people felt, what the news headlines were doing, what they were saying in the papers, social media, and where we are today. So it was a guaranteed recession back then, right? And now it's not. So again, going back to why I think it's so important to pay attention to the charts, the data, and avoid the noise. This is a sentiment trader. This is the risk on-off indicator. You can see here when and by the way, this is a conglomeration of several different indicators combined into one. And you can see way back here at the in the beginning of the year, it went risk off, and then market bottomed and went risk on again here at the end of May. Obviously, that's not what we did at our office, but this is one indicator, one piece of one of the many pieces of evidence that I'm looking at on a daily basis as I analyze the market. So I found that interesting. When I look at our pre-flight checklist, this is something that I've been using for years at this point. This is basically a snapshot of what the market looks like at any given time on a short-term basis, intermediate-term basis, long-term, and then the market climate, how things look across the board, and if it's safe for new entries into the market. What we want to see here, because I'm colorblind, so I have all my indicators set to red and blue as opposed to red and green. Everything we want to see here is a lot of blue. And what we're seeing here is a lot of blue. So I see this as, all systems go. I don't see a lot of negative here, and the negative that I hear is it's very rare you're going to see zero negative, by the way. So just because they're a little bit negative, the way you don't want to think is to say, oh, I see some negative here, so therefore it's going to get worse. If you think like that, then you're destined to lose in this game of investing. When we look at long-term asset class momentum rankings going back over long-term, right now we have the U.S. and international stocks kind of sitting at the top of the food chain, almost tied, almost exactly tied. Number 3 is T-bills, surprisingly. Next is commodities. So the commodity index is number 4. Small caps, while they're trying to rebound here, small caps are number 5, and then in the basement, it should be no surprise to you after seeing that long-term treasury bond chart that 20-year treasuries in the basement. So there are some bonds out there that are doing well, or at least better. So please keep that in mind. U.S. treasuries, 20-year treasuries are not all bonds. That's just one sector in the bond market. But when we look at bonds, that's one of the major sectors in the bond market we look at when we're observing the markets. When we look at my inverse traffic light chart, we are very clearly in the green. That green line right here in the sand here between green and yellow is marked by the gap up that took place in May. We have never closed that gap. When I say close the gap, this is the space here between this day and these two candles. That is a big open space. What that basically means is the market closed down here, and when we woke up in the morning the next day, the market opened up here. Usually what tends to happen is we tend to see gaps get closed. That didn't happen. So here's an example over here. This is a gap up. Market goes up, pulls back, goes up, comes down, fills the gap, and then heads back northward again. Market comes down. We've got a gap down. Market fills that gap, pulls down, gaps up again, fills the prior gap over here on the left, gaps up, pulls back, gaps up, has not filled that gap. Is it possible we could see the market pull back or correct and fill this gap and come back to this line in the sand between the green and the caution zone? Yeah, of course it could. But at least for now, we're seeing higher highs, higher lows. The market is at all-time highs, which there's nothing bearish or negative about that. And things are looking really, really good. So I think what's most important, though, is we always need to have our eye on the potential negatives out there, because in order to make up for a 10% loss mathematically, we need to make 11%. We lose 20% of our money. It takes 25% to get back to even. If we lose 30%, a 43% gain is required to get back to even. We lose 40%, 67% is required. And then the easy math here, $1 million, we lose 50%, we've got $500,000. In order to get back to even, if we make 50%, we've only got $750,000. So in order to get back to even after losing half our money, we need to make 100%. And obviously it just gets worse from there. So anytime the market's doing well, we need to be erring on the conservative side and looking for reasons why it would turn around and roll over to the downside. And whenever the market's doing poorly, we need to be doing, again, the opposite. We need to be looking for reasons why it's going to turn around to the upside. And going back to the quote that I mentioned from the very beginning of today, which again, Larry Williams, be quick to turn bullish, but take your time turning bearish because the market's up more than 70% of the time. Again, I think that's one of the many reasons why we need to always be erring on the conservative side when the market's at the top, but be slow to turn bearish. But when the market's heading down and things are really, really bad, news headlines are emotional, I think we need to be very, very quick to turn bullish again. So bottom line, sifting through all the noise, contrary to the vast majority of news headlines, the stock market is fine. It looks just fine right now. Just before Tariff Liberation Day, or as Gina Martin Adams put it at the CMT conference that I attended, she called it Strangulation Day. I asked back in our quarterly scouting report, is this going to be a repeat of 2016? Is this going to be a V-bottom? Is this going to be an emotional, news-driven event? And that's exactly what it turned out to be. News-driven crashes tend to result in V-bottoms, and everybody hates them, or at least the people that aren't invested in the market hate them, because they want to be participating in the upside. And the more the market goes up, the more we see higher highs and higher lows, the more frustrating it's going to get for those people. And if there's anybody that are shorting the market out there, then the more the market goes up, the more they're losing money, and the more they have to cover their shorts. And when they cover their shorts, that's more buying, and that pushes market prices higher. And don't even get me started about all the cash that's on the sidelines right now. In other words, all the gunpowder that's sitting out there. So don't be on the side of the news. If you're wrong, don't stay wrong. That's one of the biggest lessons in the world, and when it comes to investing, is there's nothing wrong with being wrong. Just don't be stubborn. Don't stay wrong. And then there is no place for politics in retirement planning and investment management. So with that all being said, that's all we have for today. That's our halftime update. Again, you want to contact me on any of the socials. If you want to get an intro call set up to get a second opinion potentially on your retirement plan or investment portfolio, just scan that QR code there, or you can email us, whatever's easiest, or you can just go to libertaswealth.com and you can find us there. So hope you enjoyed this presentation, and you can always reach out to me. You never have to be a client to ask a question, but I hope to hear from you soon. Otherwise, have a wonderful summer.